Hey there, my name is John Stevenson, and welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about fixed index annuities and are they really safer than the stock market or not? So fixed index annuities, they are considered safer than the stock market, but you have to invest into the right one. You have to do the right strategy, and I'm going to show my screen and show you exactly how I would recommend that you do this. But yes, they're not in the stock market. If you're in a variable contract, okay, a variable annuity where they got sub accounts like mutual funds, then yes, you would lose money. If the market goes down, you would lose money. They would definitely not be safer. But if you are looking for something that gives you safety, then fixed indexed annuities absolutely give you 100% safety. If the market falls through the floor, you will not lose a dime. Now, how does this work? Well, the insurance companies buy call options associated with these indexes, like the S&P 500, okay? And then they give you a portion of that growth. And in return, when the market is down and they cannot exercise those call options, okay, they expire worthless, then of course they don't experience any losses because they were never in the market, and neither do you. So that's a great way to protect your money and get growth. And if you want to turn it into lifetime income later, you can. So I'll show you both options so you can see, but I think you'll be surprised on what you can do with these. Okay, so with fixed index annuities, there's a lot out there, okay? And I specialize just in fixed index and fixed like MYGAs, income riders, things like that. Like that's what I specialize in because, well, I'll tell you why. If you go down here, look on just this page, there's almost 4,000 of them, okay? That's why. You got to have someone who is a fiduciary who knows the whole market and is willing to show you everything. And if you want to see what's available on the market, go to my website, johnstevenson.com, and you will see it. You just go to my calculators, throw up the MYGA calculator. That'll show you all the rates, the fixed rates. If you want to look at the income rider, that'll show you the highest lifetime income. And then if you want SPIAs or DIAs or QLACs, I have those on there as well. So, but let me show you here. There's a lot to sift through, and you might be thinking, man, that's a lot. And I don't know. I've heard about these annuities not paying out very much, and they got surrender charges and all these different things. I don't know if I want to lock my money in. And some of them give you premium bonuses. I mean, you can see right here, you can get a 27% premium bonus, which means if I put $100,000 in, I'll get 27 grand put in that account. What's the catch for that? Well, you're not going to have as much growth after that. Okay, then you might average 3%, right? So it still protects you against market risk, but you just drawbacks on that. Some of these have fees. Okay, you don't have to pay a fee. I'm going to show you the ones without a fee. But these ones, they say, hey, for a fee, we'll give you a higher participation rate in some of your favorite indexes. So that's a trade-off. But you have to realize if you have a year where the market is down, you still pay that fee. So I usually recommend don't pay that, but that's totally up to you. So let's go through this together. I'm going to give you an example. So Delaware is one that I want to talk to you about because they are great. They're great to work with, and they give you a lot of growth from the S&P 500. They give you, I want to say 60%. If you're in California, it's like 58%, but it's pretty much the same. So if I go up here and I'll say, let's see here, I want the S&P 500. Okay, let's see what they'll give me. So I'll go up here and I'll look at, and they give you caps. I mean, I'll just, fair warning, cap is, and to me, it will not make you as much, but they still give you caps, 11%. That's not bad. And they even give you some options for fees if you want, but you don't need to do that. So let me go over here and I'll say, well, even with a cap, and again, I'm not a big believer of caps because they just don't make as much money with them. So you see here's what it looks like with a cap. When you still have growth, you see the years where the market's down, they're not exercising those call options, so you're not making any money, but you're not losing anything either. Your account just stays where it is. So you can see this year it grew from 273 to 304, and then this year nothing, so 304 at the end of the year, right? So it just stays where it is. It keeps the higher level, and then it starts all over, each year, whatever it grows to. So over 10 years, you got a nice little account there, 516,000. You had 10 years of growth and market protection. It was great. But as you know, I love the participation rates. So I'm going to go up here and I'm going to show you this one. So 60%. Let me show you what this is. Now, yeah, they're not giving you all the S&P. I get it. But let me show you. And again, they show you guaranteed. The guaranteed is if the market goes down, it's guaranteed you're not going to lose any money. That's what that means. But the death benefit goes up. That's kind of nice. But anyways, let's look at what it'll probably do, what's done in the past. So based off of a 60% par rate, you see these higher numbers here, 17, 16, like that's what I like. Like when the market's up and it's really doing well, I want more of it, okay? And so you see the end of 10 years, It's like 576 grand. Okay, that's more than the other one. If you go look at the other one, it's 516. So you're like 60 grand ahead just because you decided to have a participation rate. You can always mix it up and say, well, I want half of it in a cap and half of it in a par rate. You can do that. Yeah, just go up here and just do it in the allocations. So you can absolutely do that. You can change things up and say, well, I'm already getting market protection. What can I do to get as much growth as possible? And you can see there's some other ones here and they have these huge returns. You're like, oh, that's great. But look at this, 2025, that means you're the guinea pig, okay? They are basing this off of back-tested results and they're testing it out on you, okay? So don't do it. I would just say if you want something that do the S&P 500, okay? They're giving you a decent cap here. Okay, you got that. And see this one has a participation rate over here, performance trigger. There's some different variations of the S&P 500 with this particular contract. So it just depends on what you're looking for. And if you want fixed rate, they're giving you the healthy 4.7% from this. So if you just want to throw it into that, you can do that too. So some people want just say, hey, I want a minimum amount that it's earning each year. Well, you could throw some of it in that and then some of it in the index. So, but what you need to realize, and I know you do, is you're buying this for safety. You're buying this for safety and growth, but realize that your growth is not as much as it would be in the stock market. Okay. It just won't be. I mean, you can see it still does well. In 10 years, it's $576,000. That's pretty good. Okay. If the market does well during this time, you're going to make more, but you're going to be subject to all the downs of the market. And if you're trying to retire during this time and take money out, it's going to be very frustrating and emotional, and you're not going to enjoy the ride. So it just depends on what you're looking for. So for me, I specialize in annuity contracts. I help people protect their money. I help people get as much growth as possible. And if you're looking for lifetime income, I help people with that too. Okay. If you're just thinking, well, I've got 250 grand, I want lifetime income and I want market protection, then just buy the guaranteed income products. Okay. You can do that. And 250,000 in Florida, if you let it sit for 5 years, it's like 28 grand a year for the rest of your life. Okay. And this is awesome. I mean, you look at, if I look at Equitrust or F&G, let's say I did F&G just for A-rated status. I'll go over here and say, all right, well, here it is, 28 grand a year forever. Never stops. I just bought a 800 grand pension. That's great. That's why you buy it for. They don't give you as much growth here. These are not growth products, not what we just looked at. So they're giving you a little bit of here, which makes your account balance last a little bit, but eventually it's gone because this is an income product. That is the focus of this product. So that's why people will buy multiple. If you're thinking I want income and I want growth, then separate it into separate contracts. Don't think you're going to get both from one, because you won't. Okay. You got to make sure you put them in the right ones. So anyways, if you got questions on this or you just want to play around with my calculators, go to my site, johnstevenson.com. You'll be able to do that. And then you can book a call with me and we'll get on a Zoom meeting. And if you're looking to purchase an annuity, I'd love to help you. Otherwise, you can book a call right below this video and it'll go to my calendar as well. So I do try to be as transparent as possible. I really do. I don't mind telling you what I make. Okay. My commissions range from 1% to 7%. Okay. That's on average. A lot of these I will make 3%. Okay. Or 4%. I'd love to make 7%, but a lot of them I don't. But it just depends on what you're looking for. And the highest rate for you is what's important. Okay. The highest income for you. That is what's important, okay? It all will even out for me because I help hundreds and hundreds of people. And so for me, my job as a financial fiduciary is to show you everything and educate you and allow you to make your own decision. So I will definitely make recommendations, but at least you will be able to make a decision with your eyes wide open, being able to see everything instead of just tunnel vision, where a lot of times people have because their advisors just showing them one thing and pushing them into that one product that pays that advisor a ton of commission. And it's just terrible. It's a terrible way to do business, in my opinion. So anyways, hope you enjoyed the video. If you do, like, subscribe, share, comment below. And I really appreciate you for watching. I really do. Thank you so much. And we'll see you next time.